Hey there, this is Chuck Wynn with Win-Win Financial, here to explain the difference between 401ks and Roth IRAs in 5 minutes or less. First of all, a 401k is a retirement savings vehicle that's designed for tax-deferred growth. What that means is you don't pay any taxes on any of the growth within your account until you take money out of the account at a later age. A Roth IRA is completely tax-free as long as you wait long enough after 59 and a half. You can take 100% of your contributions and your growth without any taxes due. 401ks allow you to contribute up to $17,500 a year, and if you're over 50 years old, that number goes up to $23,000 a year. And with a Roth, you're limited a little bit. You're only allowed to put $5,500 per year if you're under 50. If you're over 50, you can put $6,500 away. Let's really pin down how a 401k works and kind of compare it to the taxation of a Roth and how I explain it to clients. So let's say you're contributing to your company's 401k plan. You do $100 per month. That's 12 months a year. That's $1,200 per year. Typical American's going to work 30 to 40 years. Let's go 40 years. That's a total contribution of $48,000 over this employee's lifetime. Now we want this $48,000 to grow, right? That $48,000, let's assume it grows at 8% per year for the next 40 years. You might be surprised at this number, but it grows to be worth $400,000, roughly. Now, my biggest concern and my biggest question, and I need you to understand this, is how much of that $400,000 is taxable? Well, from the previous slide, you learned that all of the $400,000 is taxable. So now they're going to base your taxes based on what your tax bracket is. Let's assume that your tax bracket is average at 25%. Well, $100,000 is 25% of the $400,000. In other words, of the $400,000 in your 401k, $300 is yours, $100 is the IRS's. Let's compare this. Let's talk about with a 401k, there's 3 institutions and 3 people that I feel encourage people to put money into 401ks. 1, you've got an accountant. Your accountant regularly encourages you to put money into your 401k because you get a tax deduction for every dollar you put in. This lowers your tax obligation on an annual basis, and it makes the account look good. Helps you save on taxes. The other institution that encourages you to do this is the government. The government themselves, they give you a federal deduction, dollar for dollar deduction up to the amount that you put in. So, and the third person that encourages people to put money into 401ks is financial advisors because of the tax deferral. Put money away, let it grow forever, and hopefully it's worth a big nest egg and you can live on. Let's really crunch the numbers and figure out if this is in your best interest. So on this $48,000 you put away into your 401k, you received, let's assume, a 25% deduction because you were in the 25% bracket all your working years. So 25% of $48,000 is $12,000. This $12,000 is what the federal government gave you as a benefit or a deduction for that $48,000 being set aside into your retirement account. Government gave you $12,000 and they charged you $100,000. So the total deduction, $12,000 versus the total tax of $100,000. I don't know about you, but I would rather keep the $12,000 deduction and avoid the $100,000 in total tax, but that's up for you to decide and for me to help you understand over time. Let's go through another little concept, and that is we've all been taught, or at least a lot of my clients and a lot of people I run into have been taught that we're going to be working in a higher tax bracket and we're going to retire in a lower tax bracket. Let's compare the numbers. Let's lower the taxable rate down to 15%. Now the assumption is 25% while working, 15% while retired. 15% of $400,000 is $60,000. So for a total deduction of $12,000, the government gave you as an incentive to do this, they took later on $60,000 of total tax. So you guys can do the math. You can figure out, is the government giving you a good deal? You may not be able to qualify for a Roth IRA, and a 401k is all you can do. But if you do have the choice, you want to be educated with the impact of the decisions you're making. And I hope you guys understand this, and please share this with as many people as you can. The younger the better, because the younger they start investing, the more they'll have for retirement and less dependent upon Social Security their generation will be. Now you know the big differences on how I explain the difference between 401ks and Roth IRAs, and we did it in just about 5 minutes. Have a great day.